Thomas J. Hayes is with me, Chairman, Managing Member, Great Hill Capital. Joining me, taking a look, we've seen all four of the major averages hitting some records over the last week or so. How do you feel about that? Because it was more than 30 records for the S&P 500 closing on Monday. Amazing year. What do you think is happening here?
Well, Nicole, thanks for having me. And as you know, on your station, I've been one of the more bullish guests for many, many months, and we were aggressive buyers in the hole in April, and have ridden this entire rally. And what we've seen in the last few days is a few famous billionaires making the rounds after a 40% rally off the bottom, now calling for a melt up beyond. I think people need to be cautious and keep in mind these were the same billionaires making the rounds in early April when the market was down 20%, telling you to get out of your stocks because we were going to have a further melt down. So opinion follows trend. This is the first time in a long time that we've been a little bit cautious. Nothing crazy, but we have raised a little cash. We follow Warren Buffett's maxim, be fearful when others are greedy. And right now we're in an information vacuum going into earnings. And I think some of the things that we're going to see in earnings, Nicole, may create opportunities to get some stocks a bit cheaper prior to year end when we recover and probably have a year end rally. But I do expect some volatility in coming weeks as earnings season begins.
Do you change the strategy at all from a more bullish strategy to something that's a little more cautious?
Yeah, I mean, we did it by raising a little bit of cash, nothing crazy. We have some put spreads on indices as a hedge, very small percentage of equity in the portfolio. And then we're predominantly long with the rest of the positions that are not fully valued. But we look at a few different things, Nicole. First and foremost, and many of your audience are into options. Well, we have record call buying, 40 million contracts per day for the last 20 days, 20 sessions. The last time we saw anything close to that type of volume was very late 2021 and early 2022. And that preceded a pretty aggressive drawdown in equities. We're not calling for an aggressive drawdown in equities. We are calling for some short-term volatility with this froth. The other thing that we're looking at, Nicole, that gives us some caution is CapEx as a percentage of free cash flow among the hyperscalers is now at 60%. Some people call that bullish. That's up from 10% just a handful of years. What we're finding is it's crowding out, number one, earnings growth is decelerating aggressively because of this. Margins are getting impacted, and the ability to buy back stock is getting impacted. So what we're going to see in this earnings season, which is one of the reasons we're cautious, is with the Mag 7, their earnings growth has more than halved in the last 12 months. So this quarter last year, Mag 7 earnings growth was 32%. This quarter, it will be below 15%. And that's okay, except for the fact that the multiples on the Mag 7 have not contracted commensurate with the dramatic deceleration in earnings growth. So we're coming up against the law of large numbers. Guidance will have to be sensational in the face of decelerating earnings growth in order for there to be zero impact in this earnings season. And that's why we want to raise a little cash and be in an opportunity to buy prior to year end when we regain strength. But those are some of the reasons that we're a little cautious, have a little bit of cash on the sideline after being so bullish for so long, which has worked out very well.
Let's talk about the names you like here. Estee Lauder and Diageo. Tell us a little bit about those two names. And when you do picks, are you thinking 10, 20% over a year and a half? I mean, tell us where you think they're headed and why.
Yeah, I think that's fair. So the one thing you can note about these is they're both defensive stocks. These are consumer staples. And the last time staples have traded this low on a relative valuation to the S&P 500 relative performance was in the early 2000s, 2000, 2001. And if you remember, Nicole, well, you're probably too young, but if you remember, there were covers all over the place, whether it was Barron's, whether it was Fortune, saying, has Warren Buffett lost his touch? Because while everyone was chasing Global Crossing and chasing Cisco and chasing the pets.com of the day, Warren Buffett was buying boring defensive stocks like Procter and Gamble, like Disney, things that no one wanted during the tech boom. And over the subsequent 4 years, when the NASDAQ corrected 80 to 90% from 2000 to 2003, Warren Buffett was actually had record performance 2000, 2001, 2002, 2003, because he was accumulating all these defensive, boring stocks when no one wanted them. And I think that's a similar situation. I don't think we're going to get any type of correction like that with the NASDAQ because there's free cash flow. Back in 2000, there was a lot less free cash flow. But owning some of these defensives is going to serve you well because they're so cheap. Diageo, for instance, is just getting out of its COVID hangover. Their spirits company, high-end spirits company, Guinness, Johnny Walker, Captain Morgan, Smirnoff, etc. If people's AI stocks get hit a little bit here, they're going to need a few drinks. But more seriously, management's targeting $3 billion of free cash flow. They've done going for $625 million in cost cuts. They're finally, after a few years post-COVID hangover, returning to growth. Sales are rising again after the COVID hangover. Their non-alcoholic beverage business is growing at 40%, and they're holding market share percentages in all their key markets. So that's on Diageo. Our average holding period is 3 to 5 years, Nicole. So on any of these type of stocks like Diageo, we're looking for a double over 3 to 5 years. As it relates to Estee Lauder, one of the best aggregators of high-end skincare brands and personal care brands. They've got Estee Lauder, Clinique, MAC. MAC just did a partnership with Kris Jenner, is sponsoring that brand of the Kardashians. Aveda, Dr. Jart for the young people. My daughters use Dr. Jart. Another turnaround story. They got hurt because they were so concentrated in travel retail. If you think about the stores in the airports, et cetera, that obviously got crushed during COVID. They've moved now. They've got 31% of their business online, up from 20%. Their margins are increasing dramatically. They're returning to growth this year, 2 to 5% organic sales growth, and management targeting 1 to 1.1 billion of operating cash flow. So we love these turnaround stories as potential doubles over the next 3 to 4 years, and we think the time is right when no one wants them.
Potential doubles. We like to hear that. Thomas J. Hayes, Chairman, Managing Member, Great Hill Capital. Thank you so much for being with us.